started talking about how to trade trending market. I told you specifically there are four kind of market structure. Market structure. We have the bullish structure when the market is making series of higher highs and higher lows. It is said to be an uptrend, and therefore I will be looking for the opportunities to buy. So when the market is in a downtrend, it's making series of lower highs and lower lows. It is said to be bearish. I'll be looking for opportunity to short the market, to sell on the market. And then we say we have a ranging market. When the market is between fixed resistance and support, it is said to be a ranging market or a sideways market. Then I'll be looking forward to buying at the support and selling at the resistance. And the fourth category of market is the choppy market. When market literally has no direction and is not up, is not down, is not sideways, it's just choppy, just consolidating. So what do? I close my system and walk away and go and play basketball, or I go to gym, or I go just go and catch phone, just walk away from my system, because trying to fix yourself into such trade, you may end up losing your money. Okay, and so I started by saying to trade a trending market, you have strategies. You have strategies for trading a trending market. So we said you can use moving averages to trade a trending market. So you can use ADX to trade a trending market. Then you can use trend line to trade a trending market. You can use trend line breakout to trade a trending market. You can use Fibonacci retracement. Fibonacci retracement. Fibonacci retracement. Fibonacci retracement. You can use Fibonacci retracement to trade a trending market. And so, but I started by showing you how to use exponential moving average or simple moving average. I prefer exponential, and I told you, I explained to you the difference between the two of them yesterday. And so this is the parameter that we'll be using to trade it. Exponential moving average, you have period 10, which is red in color, and then period 50, which is blue in color, period 200, which is black in color. Please take note. That's why I decided to write it out today so that I can see it clearly on the screen. Period 10 is red in color, period 50 is blue in color, period 200 is black in color, and here are the rules they're going to be following in order to take trade using the exponential moving average, or these moving averages. When the red line crosses the blue line from down up, I buy. When the red line crosses the blue line from down up, buy. Number 2, when the red line crosses the blue line from up down, sell. I sell. When the red line crosses the blue line from up down, I sell. Then when the red and the blue line cross the black line from down up, strong buy. I used to call it buy, strong buy. And when the red and the blue line cross the black line from up down, sell. When the red and the blue lines cross the black line from up down, strong sell is a double sell, is an heavy sell. And that is what the rules is about. That is just how the rule works. So let's quickly dive into the chart, and let's look at gold here, and let's look at gold and let's set the parameter. So if you are using phone, you just tap your screen and you see all the parameters there. And then, so what do? You go to insert, then you click indicator. Under the indicator, you see trend. Then under trend, you will see moving average. Click on the moving average. And then I want to set the first one, which is 10. Then I change the color to so period is 10, exponential for the method, apply to close, then the color is red. The color is red. The color is red. What happened? insert trend moving average period 10. I click OK. Then the second one is the same process. Insert trend, then moving average, moving average, all right, sorry. The second one is 50. The period is 50. The method is exponential. Then apply to close. Then this time around the color is blue. I pick blue and I click. Then you can choose thickness. I choose the thickness of the line here. This is how you choose the thickness. The first one is thin. The second one is thicker and gradually getting thicker and thicker. So I usually choose the second one then so that it can be thick. So the blue line as a core that appeared on my screen. And so I go back to the third one, insert indicator trend moving averages. This time around 200. At 200, I go to exponential, apply to close. Then I come to this time around the color is black. The color is black, and I say boom, and then is appearing on my screen. So that I have the red for 10, period 10, the blue for period 50, the black for period 200. This period 200 is very powerful. Big institution use when you hear moving average 200 is used by big institution in just following trend, but that's not the point for today. So let me now try to move to the beginning of the year. Let me see what happens in January on gold. This is gold. Now there are certain factors I need to take note of. Number one, this strategy only works and works like magic when the market is trending. Don't forget I told you that you see, this is strategy to trade trending market, not just any kind of market. This strategy will not work when the market is consolidating. No, it will not work. In fact, it will not work in a it will not work in a ranging market. It only work when it's trading up or trending down. Okay, is important, and that is what I was telling you yesterday. I said if you want to use this kind of strategy, you know, you need to find out. I told you average, but at average, you know, instrument trend for 40% of the time on average. Instrument, forex instrument trend 40% of the time, but there are certain instruments that stay trending more than the other ones. There are certain instruments that stay trending more than the other ones. And I gave you almost about 10 examples yesterday, both from currency pairs, from metals, and then to derivative synthetic indices. Maybe go and watch the previous video to see those ones again. I will literally typing them on the screen so that you can know. So we're going to be looking at gold this morning, and then this is from the first this is from January 1. So we say when the red line crosses the blue line from down up, I will buy. And now, at this point in the market, there's a cross. There's a cross. The red has crossed the blue line from down up from this spot now. So if it crosses from this spot, my entry is likely going to be where that cross, the candle that makes it to cross. And then my stop loss will be the last swing, somewhere around here, the last swing. And so we said that I'm not going to come out of the trade. The first thing I'm going to do is the moment market moves in my favor, in my direction, I come to break even. I shift my stop loss to my entry price so that I can have a risk-free trade. Risk-free trade. So when that one is already achieved, so what I'm going to be looking for is that I'm not going to close that trade until a candle closes in reverse and closes below my blue moving average. And so I come to this place. This is where I will follow this trade until this candle crosses below the blue, the EMA 50. And so that's going to be my exit now. I will exit the market from that place. And let's calculate something. So from my entry to my stop loss is how many pips? This is about the this is how many pips now? This is 300 pips. So my risk risk is 300 pips. 300 pips. So if I win this trade now, so my winning now, how many pips? By how many pips did I win? 300 pips. That's 321 pips. My profit is 321 pips. Profit 321 pips. Pips. Boom. That's it like that. And so what is my risk to reward ratio? My risk to reward ratio is 3 2 1 divided by 300. 3 3 2 1 divided by 300. My risk to reward ratio is 1.07. 1.07. That is my RR. My RR, my risk to reward ratio, 1.07. Okay, and that is that for that one. So when the red line also cross the blue line from up down again, I'm going to be selling. And if I sell here, maybe at best I'm only just going to be having a break even, no profit in this place. But I told you yesterday that one of the things I was doing there, and I told you this is not how I trade at the moment, but this is how I started trading many years ago, because the person that actually taught me how to trade didn't teach me price action. And price action, we're going to begin price action from the next class, but this is like a cheat. This is something that can, if you have an instrument that's stay trending the most, this can actually fetch you a lot of money at regular basis. Just follow it dogmatically, it affects you. But this is not how I trade right now. I trade strictly price action, naked trading, no indicator, nothing. But this can help somebody. Okay, and so now, so later on, when I started using this strategy, so I started sieving my strategy. And I figured that when all the candles are above, when the crossing are above the 200 moving average, I will only be buying. When they are below, I will only be selling. When they are above, I will only be buying. When they are below, I will only sell. So if that's what you assume here now, that means you will not take this sell, but you will take this buy. So if I take this buy now, so what am I going to what is my entry like? So my entry will be when this cross happen, maybe somewhere around here. That will be my entry. Then my exit maybe the last swing before that happen, and then my profit will be when that thing crossed back, when it crossed back the blue to the other side. And so my risk here in this scenario, my risk here, how much am I risking? I'm risking about I'm risking 68 pips. This time around now, my risk for this next one is 68 pips. 68 pips. And then my profit this time around is how many pips is that? My profit is 266 pips. 266 pips. 266 pips. That's remarkable. That is remarkable. 266 pips. Can you imagine that? 266 pips. 266 pips. And then what is the risk to reward ratio? Oh my goodness. That's 260 divided by 68. Where is the calculator again? Calculator disappeared. 266 divided by 68. 266 divided by 68. That is 3.91. My goodness. 3.91. That is amazing. 3.91. That means whatever I'm risking there now, I'm gaining almost 4 times what I'm risking there. That's almost four times. And so it has crossed back again. It has crossed back again here. It has crossed back again here. So when it's crossing back again here, maybe at worst my entry will be here. My entry will be here. If my entry is there, my stop loss will be this last swing. And then, so what happened afterward? My exit will be when this candle closes below it. And so on that one too, I'm risking, how many pips am I risking? I'm risking 122 pips. And then to gain 287 pips. That's more than double. 187, 288 pips. And then you can see the risk to reward ratio in there. Let's calculate it again. Here now, the risk here is what? The risk is the risk 121 pips, risk 121 pips, and then we said the targeted profit from here to here is 300 pips. As I've seen, 300 pips, or what was that exactly? Sorry, 288 pips, 288 pips. Then the profit will be 288 pips. And if we want to check that, the risk to reward ratio 288 divided by 121, that's 2.38 risk to reward ratio. 2.38 risk to reward ratio. 2.38 risk to reward ratio. Two point three eight risk to reward ratio. And so that's how it goes. So every time it crosses to the upside, so you can decide to take all of them when they cross it back, but that's one of the ways I see it. So it's crossing from down up. I'm going to be buying again. My stop loss will be here. My take profit will be here. It crosses up again. My entry is here. My stop loss, my take profit is when it crosses back. Then it goes back up again. I take my entry from there. Then I'm out in this place. And then I take my entry from there. I'm out in this place when it closes back down. I take my entry from here, and then I'm out in this place. And then you discover that if you do this when the market is trending, so we said when it crosses from up down, or when both of them cross, when the red line and the blue line cross the black line from up down, sell, usually a very strong sell, a very strong sell, a very strong sell. So if I wait, this one cross from up down, if I don't take that one, but I take the one when both of them cross the black line from up down, and I take my sell, definitely I'm going to be taking my sell somewhere, okay, when this one cross, somewhere around here. If I take my entry will be, somewhere around here. Okay, that's when this blue is crossing. Red has already crossed from here. You wait for blue to cross the black line from up down. Probably this candle is the one that is forming now. And guess what? My stop loss will be this last swing, probably here. And then see what happened. My take profit is where is here when the thing crosses back. And so my here now my risk is 202 pips, and then my my profit is my profit is 358 pips, 358 pips. Then it has crossed up again. So you see now here now this will be very confusing because this is consolidation. This is like a sideways market, a ranging market. We have where we have fixed where the market is moving between fixed support and resistance. You can see here, you can see market is moving from here. You can see market is moving from here, okay, and then it's just ranging between here and here. Usually when I see something like this, all that I like to do is to bring in my rectangular box. I just draw it like this, that until I see the breaking out of this box, I'm not going to buy or sell. Okay, I just leave it like this until this box is broken. I will not be buying and I will not be selling. Just leave it like that. It broke to the downside. I'm going to allow it, just let it capture as much point as possible. Okay, as much point as possible. But so if I follow that line, so now it has closed down. If I follow the line and I see like you can see this thing is very profitable. Okay, for when the market is trending, it will not always work, but it will work very well when the market is trending. So if I cross this line, when the red line cross the black line, when the both of them cross the black line, from down up, I buy. So when I'm buying now, let's assume that when they are crossing here, which candle is forming? Probably one of these candles around here is forming. See my entry. This is my entry, and where will be my stop loss? My stop loss is somewhere around this last swing here. And then guess what my take profit will be? My take profit is remarkably here. Remarkably here. You can imagine that. You can imagine what I'm risking. I'm risking 291 pips. The risk here is 291 pips, and then that is the risk. I'm risking 291 pips, and then what's my targeted profit? My profit is from my entry to where I want to come out of the market. That's 1,143 pips. 1,000 profit. 1,143 pips. My profit. My profit is 1,143 pips. I'm telling you. And then I come out like that. Then I said if that are above, I will not take the cross down. I will take a cross up. And so if above the 200 moving average and they have crossed back up again, it has crossed back up again. When it is crossing here. When both of them, when the red line is crossing the blue line from down up, it is a buy. So I'm going to be taking my buy entry at that spot, and then when am I going to be coming out from it? I'll be coming out somewhere around here. When I come out from somewhere around there, guess what I'm risking here? I'm risking from there, I'm risking how many pips? I'm risking 144 pips, and then my profit target is 792 pips. That is amazing. That is amazing. That is remarkably amazing. Let me write it down again. Let's calculate it again. I'm risking 139 pips. Risk 139 pips. 139 pips, and my profit target is what? My profit target is let me measure it again. My profit target is from here to here. My profit target is 797 there about 797 pips, my profit target. And then if I'm to check the risk to reward ratio of that, what's the risk to reward ratio of that? That will be 797 divided by 139. What does that give us? 5.73. That is amazing. That is amazing. 5.73 risk to reward ratio. My goodness, boy, 5.73. That is remarkable. That is remarkable. My risk to reward ratio 5.73. And so these guys again, both of them have crossed the black line from up down. I'm going to be selling again. Both of them have crossed the black line from down up. Buy. And see, can you imagine this kind of a trade? Can you imagine somebody is entering a trade from somewhere, let's say at worst, somewhere around here, at worst, and then the stop loss is somewhere around here at worst, and then see the take profit now, see the take profit now, my goodness, see the take profit now, see the take profit now. What is he risking? He's risking maybe somewhere around here. That's the worst that can happen. Somewhere around to put the stop loss, okay, and then it's risking how many pips? It's risking 787 pips. And then see the target, the target is crazy. See the target is 3,148 pips, 3,148 pips. My goodness, 3,148 pips. And you can calculate that. Okay, let's do that. Let's do that calculation again. How many pips is that? I'm risking 776 pips. 776. The risk 776 pips is the risk. And then you see my target. My target is, oh my goodness, the target is 3,389. 3,389 pips. That is the profit. My goodness, profit. That is the profit. And what in the world is the risk to reward ratio of this kind of a thing? Because your risk to reward ratio is very, very important to be as a professional trader. The risk, if you have a strategy that gives you strong risk to reward ratio, you have made it for life. You will not be in a company of those people that say forex is a scam anymore. Okay, it's just that you have to be patient in this kind of strategy. Be patient until it plays through. Many times people look at profit, and that is why they always miss it. It's not about profit when you are starting out. It's about process. It's about following strategies divided by 776. Can you imagine this? 4.36. 4.36 risk to reward ratio. Okay, 4.36. Risk to reward ratio. Okay, so if I risk 776 pips, my target will be 3,389 pips. Can you imagine that? You can only calculate your lot size. And so if both of them have entered here again, I'm going to be entering a sell. They have crossed back up again, I'm going to be entering a buy. They have crossed down again, I'm going to be entering a sell. And like that. So if you have instrument that you have studied that trend a lot, like gold trends a lot. I said the number one on the list is gold. Number two is Nasdaq, USA 100. Even USA 30 also trend. Then we have GBP also trend. The USJPY trend. Then some of these stocks like Tesla, like Google, and some of them they trend. If only trend that is what you want to do, you can come on this strategy and just be patiently study it, master it, back test it, then forward test it, then you can scale up on it. Okay, so what you're going to do is you can use any time frame of your choice. So if you're somebody who can always sit down with the computer, you can use 15 minutes. You don't want to see too much. Just want to be checking once in a while. You can use 1 hour, and you can use. But the higher the time frame you use, the longer it's going to be your stop loss. Okay, the bigger your stop loss, the higher the time frame, the bigger the stop loss. Okay, and so it's very important. And the more frequent time, the lower the time frame, the more frequent you have to sit with your system to be checking and checking and checking again. But I think our advice is just a little bit medium time frame, and so that you don't have to be sitting down with computer to every moment. But it's a very nice trading strategy. So if I want to use another example, just another one more example before we have used one instrument. So okay, let's save the strategy. Let me save it for you. Let me save template, save, and I will now put chicks in trade. I will now put chicks in trade. Chicks in trade 2025. Okay, so if you put it like that, so that means if I come on another instrument, okay, if I look at this on USA 30, look at this on chicks in 3 years, you look at it on USA 30, oh sorry, USA 100, you can see it is crossing from down up. I'm going to be buying, and when it's above the 200 moving average, I'm going to only stick to buying. I'm going to be buying here, I'm going to be buying here, and my stop loss will be here. My exit will be here. I'm going to be buying again, and I'm going to be buying again, and I'll be coming out of this market. If I buy from here, I'll be coming out from somewhere around here. If you take it back down, okay, this is 4 hours. If you take it back down in the history, you discover how interesting. Imagine you have entered a buy here. Both lines have crossed the black line from down up. You're going to buy. If you buy here, maybe the candle is there, and then you are there until it got to that place. Okay, so another place I want to test the strategy is to set it on, just choose one derivative synthetic indices. Choosing one derivative synthetic indices, let me choose it here. I think it's the same thing that I have on the screen. Don't let me set it afresh. Let me set it afresh. So I have, when the red line, okay, let me take it from, okay, when the red line cross the black line from down up, buy, I'm going to be buying here. I'm going to be buying, and then if I buy from here now, it has closed back. Maybe I'll just be break. Okay, it has not closed back the blue. If I enter here, my entry will be here. My entry will be here. Then my stop loss will be when it's crossed back. When it crossed back, my entry, my exit will be there, and then my stop loss will be somewhere around it. This is like 1-to-1, and so it has crossed back down again. Both of them have crossed here. If I have an entry here, I probably will just be having an exit in this place. It crossed back down again. I'm going to be here, enter here, and out in this place. Now here again, the both line have crossed from up down. This is my entry. This is my entry here. My entry is here, somewhere around here. And guess where my exit is? My exit is far down in this place. Far down in this place. And my stop loss is going to be the last swing before I came in, maybe around here. So my entry is somewhere from my stop loss is somewhere from here to here, which is about 715 pips, and then my exit will be how many pips is that? 1770 pips. 1770 pips. It has crossed back up, but if you maintain the rules I gave you, that when all the candles are below 200 moving average, I will only be taking a sell. When they are above, I will only be taking a buy. So it has crossed from up down. I'm going to be taking a sell. I'm going to be taking a sell. So if I'm taking a sell from here, guess where my entry will be? My entry will be here. My entry will be here, and my stop loss is going to be here, and my exit is going to be here. Can you imagine that? Can you imagine that massive result? Massive result. So it has crossed back, or when it crossed back down again, my entry is there, my exit is somewhere around there, maybe a little break even or something. Okay, and that is how the strategy works. I just need you to play around it and look through it and see how see if see if you understand the strategy that I'm sharing with you here. And just like I said, it works only when the market is trending. Only when the market is trending is when you can actually maximize from this strategy. Is for trading trending market. It doesn't trade consolidated market, it doesn't trade ranging market. It trades only when the market is it works well when the market is trending. So if I enter a sell here, both of them have entered, they are up now here, they have crossed back down. When they cross back down, see where my entry is. My entry is here. Okay, my stop loss is here, my entry is here, my entry is here, my stop loss is here, and then I guarantee you that my take profit, my exit is